Taxpayers, it's no secret that state taxes in California are extremely high. In fact, California has the highest personal income tax rates in the country, which is a whopping 13.3% for top earners.
Holy sh**.
If you live in California, then you probably already know what a burden these high state tax rates can be. In fact, high taxes are some of the main reasons why hundreds of thousands of people have moved out of California every single year. But there's actually one way that residents of California can save big on taxes that many people are just not aware of. And this tax saving strategy revolves around a piece of legislation known as Assembly Bill 150. So in today's video, I'm going to teach you everything that you need to know about this new bill, the specific tax rules that were created through this bill to save a substantial amount of money if you're a California resident.
Is there a reason that you're not writing this down?
But even if you do not live in the state of California, this video can still help you because dozens of states now have similar laws and even more could potentially adopt them in the near future. So if you want to keep more of your hard-earned money in your pocket, make sure you stay all the way to the end of this video. Let's dive in. All right, guys, in order to understand how Assembly Bill 150 can save California residents money in taxes, we have to go over a bit of background first. During the Trump presidency, a law was passed called the Tax Cuts and Jobs Act. This law reduced federal income taxes, which many people were very happy about. However, the Tax Cuts Jobs Act severely limited what is known as the SALT deduction. For many of you guys that aren't aware, SALT stands for state and local tax. And before the Tax Cuts and Jobs Act went into effect, people in high income states such as California and New York were able to get a large deduction for their state and local taxes they paid, including property taxes. Well, the Tax Cuts and Jobs Act reduced this deduction to a maximum amount of $10,000. So as a result, after the TCJA went into effect, a lot of people in high income states were forced to pay significantly more in taxes overall because they stopped receiving such large SALT deductions on their tax returns. So in response to the Tax Cuts and Jobs Act limiting the SALT deduction, certain states, such as California, started to create ways to help people get deductions that could compensate for the limit that they were receiving on their SALT deduction. This is where Assembly Bill 150 comes into play. So let's talk about Assembly 150. This is a bill that was signed into law by California Governor Gavin Newsom on July 16th of 2021. Within this bill, there is a provision called the Small Business Relief Act. What the Small Business Relief Act means is that it allows certain qualifying businesses to elect to pay a pass-through entity tax of 9.3% on net business income up front. And if they do this, the business owners can get a non-refundable tax credit from the state of California for their share of the 9.3% tax that was paid by their business on their personal tax returns because it's passed through. So what this means is that if you qualify for this opportunity, you will be able to lower your overall net income from your federal income taxes by 9.3% by electing to have your business pay 9.3% tax to California up front. Being taxed on a smaller amount of income on your federal taxes can potentially help you save a ton of money. So this is not something I'm taking lightly. AB 150 is California's way of helping people to get around the SALT deduction cap and to save money on income taxes. So if you make this election, then the taxable income that you report to the federal government for your income taxes will just be 9.3% less than it would be otherwise, which potentially results in serious tax savings. But here's an example of how this works. Okay, so let's just say that you have a two-person partnership and the partnership is owned 50% by you and 50% by your other partner. And let's just say during the year, you made $2 million. Now, underneath the AB 150 law, they're stating that 9.3% would be paid up front. So we multiply by 9.3%. That gives us about $186,000 in upfront taxes that we would have to pay. Since you own half of the business, this would reduce your taxable income by $93,000, right? So half would go to you on your side of the table, and your business partner would get the $93,000 deduction on his side of the table, right? What this truly means to you is when the business files its tax returns and you receive your K-1 form that goes towards your individual taxes that you file on a 1040, what results is you're only going to receive $907,000 each. Your other partner will receive $907,000 as well, instead of receiving half of that $2 million, which would be $1 million. So this would result in tens of thousands of dollars in tax savings. Then the state of California would give you a $93,000 tax credit for your personal state taxes for your portion of the amount that was paid up front by the partnership. So this ends up becoming your tax credit that you get to receive for the year of 2023, which is a pretty significant tax credit. That tax credit was created through the Small Business Relief Act, which was geared towards small business owners that are pass-through entities. Only partnerships and S corps are eligible for this tax credit. So if you have a single member LLC or a sole proprietorship, you will not be eligible for this tax credit. C corps are also not eligible for this tax credit. Also, not all partnerships qualify. Only partnerships with individuals, such as trusts, S corporations, as partners are eligible. If your business is eligible, then you could benefit from this new tax rule immediately. Now, at this time, AB 150 is set to expire on January 1st, 2026. And this is because the SALT deduction that was implemented by Donald Trump, the Tax Cuts and Jobs Act, is currently set to expire after 2025. So if the SALT deduction cap expires as scheduled, then there won't be a need for AB 150 because people will be able to get large SALT deductions all over again. But Congress decides who gets to extend the SALT deduction, and we will know coming up in this next presidential election what could end up happening with our deductions and with the Tax Cuts and Jobs Act. So you might be asking, how many other states have made SALT cap limits? As I mentioned earlier, California is not the only state to create a SALT deduction cap. This is a workaround that was created in California to spark more people to stay in California. But there are over 30 states that have implemented a SALT cap solution that helps taxpayers to save money in income taxes. Considering that so many states have successfully created their own workaround for the SALT deduction, it's possible that every state could eventually have its own version. So, question, should you take advantage of this AB 150 rule? I mean, if you live in California, then you could potentially save thousands or possibly even tens of thousands of dollars on your taxes if you decide to stay here in California. However, making this election and getting the tax credit is more complicated than a lot of other basic tax saving techniques. So what this means is that before you try to take advantage of this, you should definitely speak with a tax professional who can give you advice about whether or not it's a good idea for you and tell you what all the pitfalls are, and can also roughly give you an estimate of your estimated tax savings before you make that decision. You don't live in California, but you still want to be able to take advantage of the tax rules that I just mentioned here when it comes to the AB 150. You should first check to see if your state has passed legislation that provides a usable workaround to the SALT deduction cap. If it does, then you can consult with a tax expert in your state to help figure out if it's a good idea for your situation. Now, if you make the AB 150 election, is it permanent? I mean, if you decide to make this election once, it does not mean that you will be stuck using this tax strategy forever. In fact, you actually have to make this election every year that you want to take advantage of it. So don't make the mistake of thinking that once you make the election that it's automatically going to populate on your next year's tax return. This is a mistake that many taxpayers have made. It is crucial that the election is made every single year. The election is irrevocable for the year that you do make it. So if you decide that you wanted to make the election early on and then decide to change your mind, you're more than welcome to, as long as you do that prior to filing the tax return. So if you make the AB 150 election, you will not be able to go back in and make changes in that same year. That means that you have decided that you want your partnership or your S corp to pay 9.3% tax to the state of California. Once you make the election, you're stuck with the decision for the year. You can always change your mind the following year if you decide that you want to keep using the exact same tax strategy. So you might be asking now, Carlton, are there any downsides to me doing the AB 150? Some people consider the fact that the AB 150 only applies to certain types of pass-through entities as a downside. I would beg to differ. W-2 earners cannot benefit from this tax rule. You have to be self-employed. So if you're a W-2 employee in California, then you might not be thrilled about the limitations of the AB 150. The fact that single member LLC owners cannot take advantage of AB 150 could also be considered a downside, if you will. However, if you have a single member LLC, then you could actually change your business into an S corporation if you want to take advantage of AB 150. Well, we made it to the end of this video. Congratulations on making it through another tax-related video. I'm proud of you. Here's a quick recap of the key information that I would like for you to walk away with. Number one, the Tax Cuts and Jobs Act limited a lot of your deductions, including the SALT deduction, which is capped at $10,000. Many states were not happy with this and thus created a workaround. Number 2, California. They have a workaround for the SALT deduction cap. It's called the Business Relief Act, which was a part of the Assembly Bill 150, aka AB 150. If you have any questions about the AB 150 or workarounds for the SALT deduction cap, feel free to get in touch with my company by clicking on the link below in the description. You can schedule a free consultation. We would be happy to answer any questions you might have as it pertains to your tax situation and go over strategies that can help you overall reduce your tax bill. You can also find a link in the description to get in touch with my real estate tax team. This team can help you to optimize your real estate tax strategy. Further, I also put a link in there in regards to my upcoming event called the Tax-Free Wealth Event. This event allows for me to spend 5 days with you going over advanced tax strategies that I do not release on YouTube. So if you'd like to, I'd love to see you inside that event as well. That's it for today's video, guys. Thank you so much for your time and look forward to helping you save money. Talk to you soon.